Okay, good morning guys. Welcome to the FX Street webinar. My name's Ian Coleman. I'm going to be your host for the next 60 minutes. Just to give you a bit of background about myself, I've been involved in the FX market for the last 24 years. Broker, analyst, trader in that time. At the moment, I'm Chief Analyst at Versa Trading. We're an analytical and trade recommendation supplier who produce reports on a daily basis for banks, hedge funds and retail investors. Today we're going to talk about money management, a subject that bores most people, as we can probably see by the lack of attendance of today's seminar. But it's a very important part of trading. I was once told that 60% of a good trading background would be technical, 30% would be money management, and 10% would be fundamental. Whether or not I agree with those percentages is another matter, but it's in there. And today we're going to talk about risk reward. We're going to talk about building short or long positions, what I look for in some of my live charts. We'll talk about some trades that we took this week, and we'll talk about the trades that we took before. And as I normally try to do, we'll also try and give some forecasts, some longer term forecasts at the end or towards the end of the hour on where I expect the major currency pairs to be going in the next sort of week or two. Okay, as I said, I work for Versa Trading. I'll quickly flick through these slides and then get to the real charts. So we supply calls Monday to Friday at 7 AM. They're quite easy to follow. Sell, buy, or basically stand aside. We have bullish, bearish, bias calls, and we then update the website or the platform later on when we get a signal to get involved. That's the dashboard. Regular updates throughout the morning. Okay, and quite easy to use platform. We've also won numerous awards since 2002. I think we've got something like 80 odd years experience between us all. Okay, so money management. We're going to talk about capitalization, trading versus gambling, drawdown, maximum drawdown, managing the trade, and risk reward. Please do feel free to ask any questions during the webinar. Sometimes it can feel that you're talking to yourself if there's no sort of interaction with people that are watching. So please do feel free to ask questions at any point. Okay, capitalization. Basically only trade with what you can afford to lose. I'm sure that if you've read any trading books, you would have read most of these, but we will go through them. Don't borrow to trade. Now, starting capital. That's always a difficult one. I would say I'd recommend £1,000 or $1,500 really. What we're going to talk about today, we're going to look at risk reward, and we're going to look at drawdown. And if you're looking to risk between sort of 2 to 3% of your capital, even on a micro account, you're really going to need that amount of money to at least safeguard you from big drawdowns. Okay, so trade in small and build up capital, unless of course you've got a system that works and you can start from the off, but most of you wouldn't be here if that was the case. The loss of capital here, we've just done a small chart just to show what percentage is required to get back to break even. Okay, so obviously it's harder if you lose some of your initial capital. It's harder to regain that capital once it's initially lost. So you can see here, obviously the second one, if your loss of capital is 20%, and you have to make 25% to get back to break even. Loss of capital 50%, and you've got to make 100% of your stake to get back to break even. And obviously the larger the loss of capital, the greater the percentage required to get back. So it's essential that you safeguard your capital, okay? And as we're going to talk about today, this can be done numerous ways. It can be done by trading in small to start with, looking at building trades. It can be making sure that you've got the right risk reward in place, and minimum of 1-to-1 at the outset. We can then look at what we call bleeding, or what bank traders call bleeding trades, which is basically, moving stop losses up, trying to gain the most out of a view. Okay, obviously it all starts with a view. You've got to have a view, you've got to have a bias, you've got to have a call to action. So your technical, analytical skills have obviously got to be there in the first place, and then your money management comes in after. Okay, trading versus gambling. Okay, you should have a systematic approach to your trading. By this, I don't mean hundreds of indicators. You want to keep it pretty basic. I mean, most decent technical analysts will emphasize on price action. I noticed that Chris later on, he's got a webinar based on price action. Price action is the core to most traders' edge. Okay, candlestick formations, reversal patterns, continuation patterns, etc. When I say you want a systematic approach, obviously some guys are scalp trading, so they might look for 5-10 ticks off a pip chart. Some guys or girls, traders in general, are swing traders, so they'll look for larger profit targets, but they'll have larger stop losses. But it depends. You first of all, you've got to decide what sort of trader you want to be, and then you need to develop your system around that, and you need to test it, you need to back test it, you need to live test it on a demo account, and just keep on pulling the trigger and basically find out whether or not you have got an edge, whether or not this system that you've developed is going to produce more winners than losers. And that can only be done over time. Nobody can expect, unless you're extremely lucky, nobody can expect to sort of start trading this week, develop a system, and know away they go. Casino rules, that's basically a trader's edge. A casino has a 2% edge on any money that's placed at the tables and the slot machines, etc. So they basically know that out of every $100 or £100 that you spend, £2 is going to go into their pocket. So they've got that 2% edge. And over a matter of time, just the amount of money that basically goes through the casino, they know that they're going to make money overall, and that's why they discount the rooms, etc., and what have you. And risk before entry. Okay, you need to at least have a decent idea of where your stop loss is going to be. I'm not a great believer in just blatantly putting it underneath the trigger candle, and if it gets taken, then you're out and you flatten and then look again, because a lot of the times you will get false starts. Okay, so I have a tendency when I put on my trades is to have an area that I'm looking at. I then watch price action in shorter time frames to watch that area. If you're looking between 50 and 61.8%, you get a trigger candle on a 5-minute chart. It starts to move up. You think, right, that looks fantastic. I'm going to buy small here. And you buy small, you put your stop loss under the low, comes down, takes the stop, then it hits 61.8%, and then it rallies up. And we'll show you that in euro dollar in a second. you need to have an idea, you need to have a range, you need to know whereabouts you're looking as well for your target area. And if it's not 1-to-1, I wouldn't recommend going in at all. Okay. If it's greater than 1-to-1, then you can obviously increase the amount of your trade, or you can go in small, and then when it breaks a certain level, you can look to build. And that's what we're going to talk about. Okay, so drawdowns. Let's just pull this in. So what we were talking previously about risk. Hold on 1 second. Yes, that's the. I don't believe that, to be perfectly honest. What I believe happens is that people start trading. They are novice traders. They come in, they look at the basics of a chart. So basically, they don't have complex charts that they look at. They have a very basic chart that they get off their spread betting supplier or whatever. They look at it and they think, well, this is going up, and they buy it, and they have a few winners, and then they look at it and they think it's going down, and they have a few winners, etc. And then they start to get a few losers, and that's when people get engrossed in technical analysis, and you look into this holy grail. And you know, I've got about 50 trading books. I've read them all cover to cover at least once. I'm just reading quite a complex book on the market at the moment, so I'm constantly trying to learn. But I take in 100% of the information that I get, and I throw out 98%. When they say that 95% of traders lose money and 5% win, I think what happens is people start, they lose a bit of money, then they disappear. Okay, so the ones that stay on, who progress, I wouldn't say they're just 5%. There might be 5% of the 100% that start, if you see what I mean. So out of every 100 traders that start, only 5% end up staying in the other. But you know, out of all the traders out there sitting at the moment trading, I would say that more than 5% of those are making money. Hope that came across properly. It's the ones that endure the pain that make the money. A friend of mine is a futures trader, Darren. He used to be down in the pits, and he says that the market will always take its membership fee. Okay, it's a group, and you have to join the group. And if you want to join that club, then you've got to pay for it. And that's what a lot of futures and traders believe, that you have to endure a little bit of pain to get a lot of gain. Okay, getting back to this, so we've got drawdown, max drawdown. So basically here, what I've done is, again, another chart, so that's all about charts of all sorts. On the left-hand side, we've got how much a $20,000 pound euro account would decrease if you risked 2% and you lost constantly. So here we can see after 10 trades, we'd have 16,675. Now, if you go back to what we talked about how much you then have to win in percentage terms to get your money back, it's quite a lot. It's, you know, 3,000 to 325 pounds. So it's a fair amount. If we go over to this side, if we risk 10%, we've had a drawdown there of nearly a third, and then to try and regain that capital loss is massive. So even if you have got a system, okay, and that system brings you in constant winners, you know, even if it brings you in 6 winners, 4 losers, you know that your law of averages, this account's going to build. But sometimes you will have major, what we call max drawdowns, where you'll have such an horrendous sequence of losers that your account will get depleted quite aggressively, and this could be sort of 7 losers in a row, 10 losers in a row. You need to make sure that you're not risking too much of your capital to make it virtually impossible to get your capital gain back. Okay. So most traders, excuse me 1 second. one advise risking between 2 and 3% per trade. It's got a system, maybe 5%. It's harder for us as retail traders than it is for bank traders, because obviously the bank's got the, a bank trader has the bank behind them. Yes, they do have limits that they can go up to, but they can build trades. Okay, they can fade in, fade out of trades. They can have a view of position. Again, in this current market, I'll be very surprised if there's many bank traders out there building large positions. I think a lot of traders are either trading options or they're basically turned to day trading to reduce exposure, basically, while it's volatile. So risk reward. Okay, 3-to-1 risk reward. Now this is just a trade that we actually had back in October when I wrote the slides for this webinar. And here, this is one of a decent signal. You can see here that we're forming a wedge formation. Okay, we've got a bullish engulfing candle. It's a daily chart. Now, the signal is to buy at the close. Okay, so we've actually put the entry in here at 133.61. But a lot of the time, if you get a bullish engulfing candle, it will be tested, and half of the bullish candle is called a Marubozu line. Okay, and sometimes it's worth just on your charts just drawing a line across the bullish engulfing candle. And basically, a bullish engulfing candle is a green candle that completely engulfs the previous bearish candle. Obviously, a bearish engulfing candle is completely opposite. There's two main chart formations that I look at, and that's bullish and bearish engulfing and insider army candles. Okay, a bullish or bearish engulfing candle, just to quickly describe it, is a complete reversal of trader sentiment. So the market's moving lower, it makes a new low in the case of a bullish engulfing, but then sentiment is reversed, and the market, instead of continuing lower, completely reverses that previous candle. The higher the time frame, the more powerful they are, and they shouldn't be ignored. The other candle formation is an insider army candle, and this one here is an insider army. Okay, the trading range of the candle is inside the previous candle, so it's completely opposite to an engulfing candle formation in the fact that it is engulfed by the previous candle. It's not engulfing, and that basically shows investor indecision. Okay, so when you see an insider army candle, it basically means that the market doesn't know where to go, but you have to wait for confirmation. And really, the true confirmation is a break of the previous candle's low or high. Some people are jumping a bit quicker. Obviously, here there's an insider army candle. If you'd waited for the low of the previous candle to break, you'd have been in there quite, or you'd been waiting quite some time on a daily chart anyway. Okay, so here I've just shown the different levels for the risk reward, and we're actually going to talk through this trade in a minute. So as you're looking at this trade or at this trend, and you've got to remember, we're not going to see any of this while we're executing this low. And I wouldn't just say, as well, just to explain one thing, just because you've got a bullish engulfing candle at the base, you should buy it, because you shouldn't. You should have a reason behind that. It should be a Fibonacci extension level. It should be a trend line. It should be a previous high, previous low. Pulling back the daily chart over 2 to 3 months. Is it a congestion area? Is it a place where price action stuck before? Is it a right shoulder in a head and shoulders formation? You need to have a reason. Okay, don't just blindly. I hear a lot of people say, "Oh, I just purely trade price action." That's fine, as long as you're trading price action at relevant areas of support and resistance. not just pulling them just because you're getting a stall or a reversal. I don't know what this one is. Oh yes, this is a 3-to-1. Sorry. So this is a 3-to-1 risk reward. So basically here we said, look, if you get 50% winners, 50% losers, but obviously your wins are 3 times as big as your losses, then obviously after 10 trades, and this is 1,000 win and a 1,000 loss and a 3,000 win, and what sort of trading size you're doing, even if we looked at it £10 against £30, okay, then after 10 trades, you'd have won 10,000 or £100 or €100. Okay, so risk reward being very important. So we're talking about risk reward, we're talking about trade management, we're talking about drawdowns on account, how much you should trade, how much you should risk of your hard-earned money into your trade, into your system. So just going back to this one, and then we'll get over to the live charts. So managing the trade, building the trade. So we've already talked about this. So we've got a 223 pip stop loss. Okay, it's from entry point to below the low. Okay, so you then calculate, obviously, from your entry point to your first area, so your 1-to-1 risk reward, and you want to look to see whether or not that's relevant. Okay, and we can see here, okay, 135.84, it is an area of previous price action. Okay, so it came down, spiked around this area, it pushed off it. Okay, as it came back into it, we had an insider army candle, investor indecision. Okay, it then broke through. What happens? It was support, it then becomes resistance. Bang, bang, bang. 3 pincer tops, and it moves lower. So we know that there's a good chance that we're going to get some price action, or at least a mild reversal or correction or stall, okay, around this sort of area. Okay. So again, here's our entry, here's our stop, and here's our 1-to-1 risk reward, 135.84. Now, as the price moves up, when we, what happened there? Sorry. As the price moves up, okay, and we get into that area, okay, we then get an insider army candle, and this is basically how we look to manage the trade. You cannot count the candle formation until she's closed, or he's closed, whichever way you want to look at it. So here we basically have refused the highs, but then we've rejected the lows. Okay, so it's in the insider army candle. What have we said about insider army candles? It's the break of the previous high or the break of the insider army that would trigger or potentially trigger either a move, a continuation of the trend in the same direction, or a potential reversal. So when we see this insider army, we're basically pulling the stop to the low of the insider army candle. So we're protecting this trade. So we bought long here, we put the stop in here, okay, at this indecision. So again, it's just reading the candles to read your trade. You don't want to end up giving back everything that you've earned, because you have earned it, because you've put risk on the table. Okay, and then, you know, for that risk, you want at least to get some reward. So here we've got the stop to the low, and then it breaks the candle high. Okay, and keeps moving up. So then we basically move trading stop to the candle low again. Okay. Again, we've got to be wary of previous areas of support and resistance. So we get up towards this level, okay, and we've got this previous area of resistance, okay, which is around 139, the figure. Now, if you're looking at that could, remember, we haven't seen this part of the chart, okay, so even if you've got a long-term bullish view, there's a good chance that could come down to form a reverse head and shoulders formation. So this will be the left shoulder, this will be the head, this will be the neckline, okay, and then this will be the right shoulder down towards sort of 136 the figure. So again, protecting the trade, stopping to the low of the candle, bearish engulfing, okay, and stopped at 137.21. Yes, the market continues in the same direction, but here we're talking about money management. At that point, as far as I was concerned, it was not worth the risk of any, me risking any more capital and me trying to safeguard my profit, because I've got various reasons. I've got a bearish engulfing candle at previous resistance. I've got a chance of a head and shoulders formation. I'd have preferred to look for another buy entry around here. Okay, it does spike, which is obviously rejection of the lows, and it does eventually break to the upside. But we've locked in profit, we've taken profit with money in the bank, we've risked 223 pips, and our reward ended up being 360. And I'm not going to go through this because this was an old dollar Swiss trade that we built up on the back of Elliott wave and head and shoulders formation and bits and bobs like that. I think we're better off. We'll come back to that if time's permitting, but we're better off going to the daily chart, the live charts, and we can talk about what's happening now as opposed to what's happened in the past. Any questions at all from anybody? No? Okay, can you do me a favour when we go over to these charts? They're a bit temperamental, just in the fact that I keep on having to reload this camera, okay, just to highlight the charts. The CQG charts, okay. I wouldn't expect many retail traders anyway to purchase them because it's expensive, basically. But it's great for the job that we do because it does let you capture charts quite well. Got some great charting tools on there, and well, for us it's worth the money really. Okay, so this is a plain euro dollar chart. What I'm going to show you is basically what I overlay onto my chart. CQG, Connie it's called. So I'm going to show you what some of the indicators that I overlay on my charts and how I read the market and trying to get the trade. Okay. So here we've got euro dollar. Okay, it's a plain vanilla chart, whatever you want to call it. Okay, time frames, as I've said previously, and we did do a webinar on time frame breakdowns last week, highly important. Okay, they give us a higher time frame, gives us a bigger bias. And hopefully you can see a weekly chart here at the moment. Hopefully I'm not going to have to keep on clicking on and off every time I go to a new time frame. So as I said, it's a vanilla chart. That's all it is. We can see, as you always can after the event, we can see bullish engulfing candles at the base. We can see bearish engulfing candles at the top. Bullish engulfing here, bearish engulfing here, spinning bottom here, inside candle here, etc., etc., etc. As I said, what I look for is to try to get a bias off a larger time frame and then break it down. But I don't just have plain charts. I want something to show me areas of support and resistance. Okay, and for that I use one moving average. It's a 15 EMA, exponential moving average. I find that some people use moving averages for crossovers. I use a moving average for moving support and resistance. Okay, the market's constantly moving, so we shouldn't necessarily just have static trend lines. Okay, what has a tendency to happen is, as we all know, everything moves in waves. So we'll get a move up, we'll get profit taking correction, comes down, but it's only a correction, so we get higher highs, higher lows, keeps on just chipping, and then eventually probably get a wedge formation at the top. That should signal to reverse, and then she comes off. So I've found that the 15 EMA is a very good indicator to capture those moves down. Okay, and that's in all time frames, and it's in all currency pairs. So I'm going to put on the 15 EMA. We're then going to put on the RSI. Okay, the RSI I have as a 15 setting as well. EMA, exponential moving average. Okay, so there's basically three types of moving averages. There's a weighted moving average, or the most commonly used one is SMA, which stands for simple moving average, then an exponential moving average, then a weighted moving average. Weighted moving averages are used more commonly in stock market analysis because I don't really know why. I think it's because it can be, I think you can weight it against volume. A exponential moving average gives more emphasis to the front end. So basically, just to explain what a simple moving average is first, a simple 15 SMA takes the average price of the last 15 candles. So if it's on a daily chart, an SMA, 15 SMA is the average price, simple moving average price of the last 15 days. Okay, obviously it's on an hourly chart, last 15 hours, etc., etc. Exponential moving averages just weight the front end slightly. In fact, I can just show you here. It won't change a great deal. If you change that to simple, okay, when I press apply, it just see how it flattens it out slightly. And then we have it exponential. It more I'd say it curve fits better. Yes, I've never used 21. So the RSI is a 15 setting as well. That is used purely for a bias. Okay, if it's above the 50 level, then I've got a bullish bias. If it's below the 50 level, I've got a bearish bias. Okay, I am a trend follower. I'm looking for price action to get me into the trend. I'm looking for reversal pattern to get me in cheaper. Occasionally, I do mean occasionally, I might use the RSI for trend. Okay, so I might put a trend line on the RSI. I actually prefer RSI trend lines than I do trend lines on charts. It sort of just gives sort of confirmation of breaks really. I determine trend. It depends. We actually do quarterly calls, which is for 3 months. Connie, I think there's 15 or 15. Okay. We do quarterly calls. We do weekly calls, which is over obviously a 5-day time frame, and then we do intraday calls. So intraday calls, I take my bias off a daily and an hourly chart, 4-hourly chart. Weekly calls, I look at anything from sort of monthly, weekly, quarterly. So it depends where we're forecasting. It depends whether or not it's intraday. Like I said, I'm not a great fan of scalping. If I was, then I'll be using hourly and 15-minute charts probably. Okay, so we've got a moving average, we've got the RSI, and then the old faithful, okay, the Ishimoku cloud. Now, I know a lot of people get freaked out by the complexity, or what they think is highly complex. Okay, even if you just want to look at it for support and resistance, okay, just these cloud formation, then you can just take off your lines. Get rid of the dragging line as well, or the lagging line, I should say. Okay. And then we can just have it as cloud. Okay. So we've got a bias. We know where our support and resistance are, and we're looking at a weekly time frame. Now, I'm just going to talk about Friday's trade. Okay, so price action. We've had a very decent move up. Notice how we battled it out against the Ishimoto cloud, and then our support level. Eventually broke inside, came back to the low of the cloud, broke out, and then came back into this area. Okay, we can see here quite plainly, or we can now, hindsight again. Okay, we've got an area of support. Okay, so it was support, it then became mild resistance. Okay, it then became support, and then support again. But even if we don't take note of this this level here, this 130.30 level, what do we have? Okay, we have an engulfing candle. Okay, not just engulfs, but takes out the whole of the range of the previous candle. So we've had a decent move down, and then we've had this engulfing candle. Just to show you a little trick on this chart package, which is not going to work. These yellow formations tell me of bearish and bullish engulfing candles inside Aramis, pin bars, etc. And it hasn't actually highlighted that one. I don't know why it hasn't highlighted that one. Because the red, so the green or the close was just marginally lower than the previous. Okay, so this is Thursday's candle, this is Wednesday's candle. What I look for in an engulfing candle, and a lot of people, if they've ever listened to my seminars or webinars before, is that I'm looking for price action to take out the previous candle. Okay, so it doesn't necessarily have to close above. If it does, that's great, but I just want it to show me a reversal of investor sentiment. And that's what we're looking at. We're looking at investor sentiment, we're looking at trend. Okay, so going into Friday, we've got, or I've got, a bullish bias off this daily chart. I've got an area of support. Okay, remember we said that if we're looking at inside Arami candles, bullish engulfing, bearish engulfing candles, that we want them at previous areas of support and resistance. So we've got that. Okay, and I'm not going to talk about now about the breakout of the cloud, because that was a proper breakout of the cloud. The actual lines, the send lines and the lagging line, was showing that it was a false breakout. Okay, and you're going to have to come to the next webinar, or the webinar on Ishimoto cloud trading, if you want to. So we won't talk too much about that, but I do constantly watch these larger time frames as well for support and resistance areas. You can see that the support, obviously the support here is massive. The support here is thinning. Okay, and as we're moving back up, we can see the forward projection, and that's the great thing about Ishimoto, is that it's showing where the support area is going to be if we stay up around this level moving forward into April. We can see there's going to be a lot of support. Okay, so we got our bias off this Thursday candle. Let me take it down in shorter time frame. Okay, 240 for the 4-hour candle. What do we have off the base? Okay, we had a bullish engulfing candle. I didn't take the buy there. I was actually bearish coming into this day, okay, but it's a decent bullish engulfing candle. What happens is this formation here, this move up, this break above the moving average, gives us that bias. We're just going to lose the candle formations in a minute because we can see that this is a large engulfing candle. But we're going to talk about why we took a long trade here and then how to bleed this trade up, okay? How to keep it going, because that's what we're looking for. If you're putting risk on, you want to maximise reward. Don't want to just jump in, jump out. I would say that if you're using a spread betting platform or a trading platform that lets you do micro lots or small amounts or whatever you should endeavour to do, i.e. even if you're looking to trade in a pound a point, you should really trade on a platform that will let you take 50p profit, because you really want to get something locked in early doors basically to lock in some profit, because then your stop loss in your other half or your if you're trading 2 units, your 1 unit that you've got left back on, even if it goes down and takes that stop, then there's a good chance that you're going to get out flat. Okay, if you've only got 1 unit on and you can't halve that unit, then that's the only unit you can play with until you double up, or until you get out, whichever you prefer. Yes, you can move the stop loss to entry. As we know, charts, markets move in waves, and you won't have picked the base. So there's a good chance that just on a correction, the market might just come back and just nick your stop and then rally or decline in the direction that you're in. So we've got this 4-hour candle, so we've got that confirmation candle, that bullish confirmation down the bottom. We've got, I didn't really look at this, but that's quite decent as well. So we've got the break of a trend line. What happens in wedge breakouts, channel breakouts, sometimes in triangle breakouts, but not as much, the market will have a tendency to come back. Okay, so it'll make the resistance, it will then break the resistance and then come back to test, and that's what happens here. Okay, I'm going to take that off the chart because I didn't look at that. Again, that's just a bit of hindsight. So this is the 60-minute chart. So we've had this move up. Notice how it stopped at the top of the Ishimoku cloud. Now, once I've seen that so 15 EMA and it's a 15 RSI with a 50 line on it looking. So I've got that bullish thing. So I'm looking for a retracement. Now, I'm not fanatical about Elliott waves, but I do like corrective sequences. And corrective sequences are normally in 3 waves, so an A, B, C, or some people call it an A, B, C, D. Okay. We want to be looking at it between 50 and 61.8%. We want to be looking for reversal candle formations in short time frames. And here, another thing I didn't really look at on Friday, I would have thought that's probably around 261.8%, that move up. And again, that's an invalidated count as far as Elliott waves concerned, because waves, if you took this as waves, 1, 2, 3, 4, this pullback takes out the top of this wave here, okay? But it's given us a good top, okay, 261.8%. We can see the sort of previous area of resistance, moves down. Thanks for that. So again, just looking at this chart, looking at price action, you must be able to see where your support is, where your resistance is. Okay, this has given us a decent move up. It's around 261.8%. It's at the top of a cloud formation. We get an inside Arami candle. It breaks the low of the inside Arami of the outside candle. If it breaks the low of the outside candle, what happens? It comes down. It touches the 15 EMA, which is then support. It then moves up. What happens? It touches the top of the cloud, which is resistance. It gives us an outside bearish candle. What happens? We move down. Okay, so these levels here and this whole move up, this is bullish price action. This is bearish price action. This is an inside Arami candle at support level. This is an outside bearish candle. You see, it's like reading a book, and we've got to learn to read what the market is showing us, because what the market is showing us is price action, and it's showing us the flow of money. Okay, it's showing us where traders basically are changing their minds from being bulls to being bears, to taking profit, to building long positions, etc. Okay, so here we've got on our retracement, our fib retracement. Now, this is 50, this is 61.8%. I mean, that is tip perfect. 130.48, lower that candle's 130.48. It doesn't normally happen like that. And fib levels should be areas that you're looking to for reversal patterns, not blindly. I mean, you could have blindly bought that; it would have been a fantastic trade, but they're not, just a blind buy and sell area, because you've got to look for price action in shorter time frames. Okay, so then we take it down to 5 minutes, so everybody can still see that. Can we still see that? The 5 minute chart now. Bookie, you're my man. No? Let's just refresh just in case. Oh, you can. Great. So this is the 5 minute. Okay, so this was this move down. Okay, in that 5 minute formation. I actually took the long here. Okay, because I've got an inside Arami candle. It was between 50 and 61.8%. Yes, it is. But I have proof on our website. We call live trades all day. So I'm trying to explain to you what to look for. I can't predict what's going to happen in the next 5 minutes. I can't. I have a bias. I have my analytical skills that I use to try and predict the market. But I can't. I think this is a three-way pullback, by the way, in the moment in euro dollar. I don't think by any stretch of the imagination it will take last Thursday's low. That is my prediction. I'm trying to show you, Solomon, how our trades, how I execute trades, trades on our website, and how our clients benefit from our knowledge, basically, and how you can build on your own education and how you can build positions to increase your trading account, basically. But yes, this is a history lesson. And most technical analysis is a history lesson. All TA is a bias. Okay, a wedge formation has a 70% bias to break to the downside. A bullish engulfing candle has a bias to be a continuation pattern. An ascending triangle formation has a bias to break to the upside. Everything's biased. What TA is building a picture that has a bias to move in one direction more than another, because every moment in the market is unique, and just because you have that bias doesn't mean that the trade's going to work. But you have the odds on your side. Going back to when we talked about casino edge, that's it. That's the edge. It's nothing more. You're not going to get 100% of your trades correct. So we took that trade there on the confirmation, on the break, okay, but had the stop loss, okay, outside the cloud. The stop loss down here below 61.8%, okay. The way that I look to build trades in my personal account okay, is to then use areas of support and resistance. And when those areas of support and resistance move or break, I then look to build. Okay, so it breaks here, breaks out of the trend line. I'm not waiting for an hourly chart to complete here. Okay, I'm looking for this area of resistance to break. So I put a trend line on, offset off the highs. So remember, as far as I'm concerned, this is 1, this is 2, and this is 3, and this is the one I want. This is the bullish price action. This is the one that's going to make me a few quid. Okay, so when that breaks, it breaks the cloud and it breaks the descending trend channel, which is here. Okay, what happens? Slight reversal inside of army. It breaks the high. Okay, breaks the high, rallies up very quickly indeed. And then we took profit here, believe it or not. Which some of you skeptics will not believe. It's all hindsight. Okay, 161.8%, or around 161.8%. Okay, and then bought it at 68 yesterday. Why did we buy it at 68 yesterday? Because this is just a corrective channel. Okay, I was personally just looking for a small pullback in here. I've got a bullish engulfing candle. I'm above the RSI, I'm above the cloud. I've got a fib count which says that I should just get a small reversal, and the rest is history. And I got out at I think around about the top actually. I got out half on the end of this candle, and then I pulled the stop loss in. So what I'm trying to sort of get across to you guys today is, if you've got a view, or even if you've been given a view, so somebody will turn around and say, you know, you're reading a report, somebody says that it's a reverse head and shoulders Aussie dollar, which it looked good a couple of days ago in the one hour chart formation, then you don't just want to buy one unit, put your stop loss in, and let it, you know, move up to your target. If you're going to get the maximum reward out of your trading, if you're going to be able to build your trading capital up, not necessarily quickly, but with decent money management, with increasing your trade size. And when you do double up, obviously most charting packages or most broker packages will tell you what your average price is. So your average entry price is. So if you bought some at 60, you bought some again at the figure, obviously your average price is going to be at 80. Look to that 80 level. Is it a relevant point? If you put your stop loss there in at break even, you're no longer 2 units. Is it likely you're going to get taken? No, and manage your risk, and then build this account up. Mate of mine we were doing some calculations the other day, and we were saying that how much would a retail investor, if they made 6% every month, every week on £1,000 account. My mate did a calculation on compound interest and blah 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 blah. You know, it's phenomenal, but you're not going to get that sort of percentage increase in your account unless you build on winning trades. Okay, you build on winning trades and you cut out losing trades. So that's the best advice I can give anybody. Try and bleed your winners and cut your losses, because if it goes through your stop loss, then that was to start with, that was your one-to-one risk reward. And secondly, if it goes through your stop loss, that should mean that your view or your edge is wrong. Any questions? We've got 4 minutes left to go. Any questions, anybody? I can't believe that I've talked for 56 minutes and nobody's got any questions whatsoever. I've either been talking absolute rubbish and nobody can understand a fit word I've been going on about, or I'm the best FX teacher in well, that's definitely not the case. Thanks, Connie. This chart package is CQG. It starts at around £350 a month for a basic package. You then have to pay exchange fees and bits and bobs, and I wouldn't advise it for retail. Pro real-time charts are really good. They do most technical indicators. I'm medium-term bullish on euro. I'm sure you're talking about euro dollar there, not euro sterling, but I'm medium-term bullish. I think that this is the end of the fifth wave. Going back to the daily chart, what we're getting today, what's forming today, get out of it. Move trend. An insider army candle. So investor indecision. All that I think that's happening here is a small pullback. Okay. So 5 waves up. What do we get after 5 waves up? We get 3 waves down. Areas of support. Remember, I'm looking to trade with the trend, not really the correction. So we've got, this is 50, this is 61.8%, this is 78.6%. Might even get down to here, but like I said, I don't think it will take, well, I'm pretty sure it won't take this. So it's all lining up quite well around this sort of level. So I'm a medium-term bear, but if it's a 3-wave correction, it's going to be very, very choppy. And then I'll look for anywhere between here. Here's the channel. So anywhere between 130, 147, 130, 60 for bullish signals, basically. Bottom of wave 4 is normally quite a good area, at least for a bounce. You're also going to have some flattening cloud support around that area. It's also going to be about 50 hours high. So you're probably going to get something like 1, 2, 3, 4, 5, 1 or A, B up, okay, and then C back down, and then the next rally. Okay, thanks for attending. I appreciate it. Good luck with your trading. If you go onto our website, we do a daily free call, which is random. Okay, it's www.first4trading.com. And we also do a discounted introductory offer at the moment. Okay, best of luck, and I'll speak to you all soon. Cheers. Bye.